Welcome to Barenaked Money, the podcast where we strip down the complex world of finance to its bare essentials, with your hosts Josh Sheluk and Colin White, portfolio managers with Barenaked Capital Management Inc.
Welcome to the next episode of Barenaked Money. We got Matt here, fresh off vacation, so he's going to have more energy than usual, filling in for Colin today. And Matt, you brought this topic to me a few weeks ago, something that piqued your interest. Why don't you introduce the topic?
Sure. Thanks, Josh. I spotted a study that came out, this year's study from Vanguard, which is a large asset company here in Canada and globally. And they specifically looked at Canadian investors. How do Canadian investors invest? Where do they invest their dollars? And what do our portfolios look like versus the other countries they operate into, versus how does an American invest, an Australian? And what we found is what they've found over every year, basically, is that here in Canada, we exhibit something called home bias. We like to invest in the things we know: Canadian companies, Canadian stocks, Canadian bonds. This is a phenomenon called home bias. And while it's true here in Canada, their results show most countries have similar biases. They invest more so in their own markets. And there's reason for this. Again, it's familiarity. And when you operate in a country like Canada, you know the rule of law exists. There are some tax benefits to investing in Canadian companies by the way of dividends, especially. So there's some reason to know and some comfort to feel to invest more into Canada. But their numbers are quite staggering in terms of how concentrated Canadians are in a market like ours, a small market globally. It'd be very strange to go to a country like the US or any other and to find someone who would say, I want to put 50% of my assets in Canada. I think you're not going to find that very often. But here we're very comfortable doing that. Our market represents only 2.6% of the global stock market, but the findings of this study show that our Canadian investors invest about 50% of their stocks into Canada. So, from a purely theoretical basis, we might be 19 times over allocated to Canada. Now, there are reasons, again, why we might show more than just our natural weighting to the globe for stocks, for what we might allocate. I think we might have gone a little too far, and we could talk about the risks as part of that, because I think it's, we like to think about Canadian dividend paying stocks as quite safe. But there's data that shows that it's not quite so safe, and especially in such a concentration. So that's really what piqued my interest here. Just a latest update of the numbers, a continuation of a trend, I suppose, and maybe something to opine on here where we know diversification is important. Canadians on average don't necessarily show it to the extent they should.
Right. So, yeah, so this is something that's been going on a long time. It's persisted across many, many years or decades, and it persists based on the evidence that Vanguard is showing us across many different countries as well, which you highlighted. So I think that's important to mention. Now, you touched on it a couple of times there, reasons why this happens. So do you think it really is just a familiarity or a comfort level thing? Is that why people have more of their assets in Canada than they should, quote unquote, should?
I think it comes down to, I think that's a big component of it. And then I think a pretty meaningful component is an idea that investing in a lot of these Canadian industries is safer. And that if you own what you might consider some blue chip type businesses, if you own a collection of these, that's a safe portfolio. And that's a good one to allocate to, because you'll get an income stream from it. And it should be safer than those risky stocks that exist beyond our borders. Now, that has been disproven, especially again in this study here, that is shown that owning Canada in the weight that we do is actually riskier than had you diversified more properly globally. So I think that is the bigger component. It's just this misinformation that when you own Canada stocks is safe, and to overweight it can only be safer. But that's not necessarily the case.
And it's funny because Canadians are sitting here thinking, well, if I own Canadian stocks, I'm safer. And Americans are sitting in the US saying, well, if I own American stocks, I'm safer. And the Japanese are sitting in Japan and saying the same thing. And Australians are sitting, saying, if I own Australian stocks, I'll be safer too. So we can't all be right. We can't all be right. And maybe none of us are right. Maybe that's the point.
Humans are funny, right? We all come to this similar conclusion, but in our different countries.
Yeah, yeah. So I guess true to the term bias there. So you mentioned I want to stick on the potential reasons or benefits of it before we go to some of the risks and drawbacks that you highlighted as well. But you mentioned tax. So is this a real financial, numerical, mathematical benefit of a Canadian investing more in Canada?
I mean, all things being equal, if you could choose between a similar performing total return stock, I suppose, from Canada or beyond, after tax, given the dividend treatment of a Canadian stock, you'd be better off owning that business. Now, we know there's a lot more to consider when making an investment decision, and we know all things are not equal. So there is a benefit that does exist there if your return is comparable in this country versus another, but it's not a reason to make a significant overweight, as on the basis of it is a small factor though that does result in, I think, some further bias to Canada, just knowing, well, there's no withholding tax on that dividend, and I get to keep the full thing, and and even favorable treatment upon it at that tax time. So
Yeah.
there's something to that, but in the end.
So you said small. How small is it? Can you give our listeners some context as to how material or immaterial the difference is?
Well, it should be, and I suppose it does depend on province as well.
Yeah.
But you will find that foreign dividends are taxed liking, so that should follow more to your bond income or your other income coming in. Where dividends receive a dividend tax credit, and you might see in the neighborhood of, accurate to say, 10 to 15% or so of a discount, or more in your pocket, I suppose.
Yeah.
Based
Of
on
the dividend. Of the dividend.
Yes,
Yeah.
exactly.
Yeah.
So there's a benefit there.
Yeah. So I threw you kind of an impossible question because it differs.
Thank you for saying that.
Yeah. It differs depending on which country you're coming from as well, because you invest in the US, there can be foreign dividends, tax credits, and reduced withholding taxes and all these things. So I threw you a question that was basically impossible to answer, but I think it's probably safe to say that the difference is probably minor to your overall after-tax return. And we're probably talking basis points, like 10, 15, 20 basis points, maybe. Probably not a whole lot more than that. Is that fair, you think?
I mean, that's very fair. And I suppose that's all assuming that every dollar you invest is taxable. And that we know that isn't necessarily the case.
Sure.
There is no longer a foreign investment restriction in your RSP, in your RIF account. And you're fully able to allocate wherever you like globally in any of your tax deferred or accounts like that, tax-free savings accounts, first-time home savings accounts. All of these accounts can be invested in any country within the globe, and there's no restrictions there. So, and then of course no taxes applied on the return. So maybe it's even less than that.
Yeah, maybe. And okay, so moving on to the risks. So you mentioned diversification. So how is it that being too exposed to Canada, I know there's a variety of different ways, but how is it that having too much of your portfolio in Canada reduces your diversification, aside from the obvious, just being too allocated to one country?
Well, the big reason for that, it comes by way of where our market is based up on in terms of sectors. And then really, when you dive down even deeper, where the concentration lies in terms of company. And so when our market here in Canada is significantly concentrated in those two spaces. So by way of the top 10 companies, they represent 37% of the market here. When you compare that globally, the top 10 companies in most global markets represent about 16% of the market. So when you're over allocated to Canada, you're also over allocated to these top 10 largest companies within our country. You're also over allocated, and these top 10 companies would represent many of these sectors, to financials, materials, and energy. These three sectors, by the way, are very are quite economically sensitive and generally very volatile as well. So when you are overweight Canada, you're overweight a handful of companies and also a handful of sectors, and most of them are quite volatile. So you're bringing about more risk than maybe you realize by overweighting in Canada with a concentrated small market that we are.
Yeah. Yeah, I get so again, just the composition of the market that does it. And just to take it a step further, I had a portfolio manager say to me one time, just look at your opportunity set as well. So if you think of I'm a Canadian investor and I'm investing only in Canada, you have probably several hundred viable investment options here in Canada. I think that's probably fair to say. And as soon as you look outside of Canada, he said, now I have 30,000 viable investment options. So if you think that a larger field to choose from is going to result in better outcomes, then it's kind of a no-brainer that looking outside of Canada's borders are going to add some new and interesting opportunities to you. And I think that makes total sense. But I think just to emphasize how concentrated the Canadian market is. So it's not only the top 10 companies that make up 37%, I think you said was the number of the market, but all these companies are very similar companies. Not all of them, but a lot of them. Like you're going to see a lot of the big banks in there. Financials definitely dominating that top 10. So it's even maybe a little bit more egregious than at first blush. And I think those three sectors now, correct me if I'm wrong, is it like 70% or so of the Canadian market that are made up by financials, materials, and energy?
Yeah, that sounds about right.
Yeah. So yeah, as you said, these are all industries or sectors that tend to be a little bit more economically sensitive. So if you start looking abroad, um, maybe you can just reduce the volatility of your portfolio a little bit, or even if it's not a volatility thing, the perceived safety of having a better cross section of different sectors or industries is probably going to help from an overall risk management perspective.
I think you're very right. And Vanguard showed that by way of a chart. And I love when they show information by charts. So we have here them showing up, where you'd sit on a risk return basis, essentially. If you define risk as volatility, which they have here, and marking where a Canadian portfolio would sit in terms of its recent performance or historic performance on a absolute return basis, and then on a volatility basis, where that would leave them in that chart. And then where would the investor have experience if they had invested in a diversified way, in a global way. And you can, without question, see that return stays in the same range, but volatility is moved down materially. So there's without a doubt over time a smoothing of returns, a better just experience for investors, and a de-risking, you might say, to reducing that Canadian exposure.
Yeah, I did some research on this last year. And I don't know if I shared this with you or not. I can't remember, but we were debating amongst ourselves on our investment team whether Canada has worse returns, a worse return outlook than global markets would. And I think there's still some debate internally whether this is true or not, because historically, and I went back about 70 years and did find that, yeah, the global market tends to outperform Canada, but it wasn't, for the nerds out there, it wasn't statistically significant. So it might not be something that you can actually rely on, and it might not be something that you would expect going forward. And I think that's maybe the bigger point here is maybe the returns are similar between Canada and the rest of the world. Maybe there's no return difference to be expected whatsoever. But if you think that you can get either better diversification or less economically sensitive businesses or less concentration by going globally, there can still be a benefit even if you're not getting better returns, even if you're getting the same returns. By reducing the variability of those returns, that's still a benefit to the portfolio. And that's kind of what I saw with the numbers when I looked back as well. So it's interesting to see them kind of replicated by Vanguard.
Yeah, I think Vanguard agrees with you to an extent. In fact, they're saying they're not saying all investors go to only 2.6% of your portfolio in Canada. In fact, they've run a study that said for Canadians, it'd be reasonable to be invested about 30% in Canada.
Mm-hmm.
The remainder to be invested and diversified globally. So, there's good businesses in Canada. There's reason to have investment in Canada. There's maybe more of a comfort that comes to some of us and to some investors by doing so. But there's risk when you put half of your eggs in one basket.
Yeah. Did you see where they came up with the 30% number? Because that, from the numbers that I saw the number, but I didn't see how they actually landed on that 30% number.
I did not see, the data behind that. I've seen the chart with the
Yeah.
results of their 30% allocation, but how did they come up with that exactly? I'm
Yeah.
not sure.
And it's hard to say this is the exact number for anybody, I think, because
Mhm.
again, we don't really know exactly what's going to happen going forward. So it's kind of like, yeah, maybe accommodate the bias to some extent and adjust and understand some of the tax factors to some extent that may move the needle a little bit. When we did the numbers earlier this year, last year, I can't remember what it was. We kind of arrived at somewhere around the 5 to 25% range, and it kind of depends on what your objective is. Because actually, funny enough, even though the rest of the world is more diversified than Canada, Canada actually does still provide some diversification benefits to a global portfolio because it is a little bit more resource heavy, a little bit more commodity heavy, which is something that tends to perform a little bit at maybe off times with the rest of the portfolio, when you're looking at it from a global perspective. So it's almost like mutually beneficial to have some global and a bit of Canada in there as well.
Yeah, exactly. And you hear of times when managers are saying they're going overweight Canada, and often what they're doing or what they're thinking when they say that is, we think it's a time to be in industrials or to be in materials, to be in energy, maybe to be in financials. And that's really what they're saying when they say, let's go overweight Canada. Now, is it always time to be overweight these sectors? That I'm not so sure of that.
Yeah. So one of the other things, I think we always approach this from a very stock specific focus. Like it's always about equity markets. It seems to be anyway. Do you think it's a different conversation if we're talking about bonds versus stocks, or do you think we approach it the same way?
I think I think there's almost more risk when you think about the bond market. When you think about the major borrowers in this country, and you can look at top 10 borrowers, it's even more concentrated, but of similar sectors. You have financials, energy companies,
Right.
maybe telcos would sort of round out the very big borrowers in this country. And if you look at the bond portfolio of managers in Canada, they look like the space. I mean, the opportunity set is quite concentrated, and if things were to tighten up in any of those sectors, it would be felt quite quickly by Canadian bond holders. So concentration absolutely exists in both the stock and the bond market, but maybe even more so in the bond market.
Yeah. So that's interesting. You immediately went to corporate bonds, and I hadn't been thinking of it from that perspective, but I think you're probably right. There might be some more like telecoms and utilities exposure, just off the top of my head in the Canadian bond market, but they're like the high yield bond market, for example, is almost non-existent in Canada. That's something you really need to go globally for. So there's I think some truth to that for sure. One of the things that I've been thinking about, and one of the things that we've been talking about with our portfolios on the bond side is the global exposure. I still, for the record, I still think is extremely important on the bond side, but maybe depends what you're trying to do with the specific bond allocation, because a lot of times bonds are meant to hedge your risk or to reduce the risk of the equity part of your portfolio. And that risk tends to rear its head when there's an economic downturn. So economic downturn, stocks go down. And if you're exposed to stocks in Canada, and to the economy in Canada, both of those things are bad. But if you had government bonds in Canada, for example, and your economy downturns, that's hurting your stock portfolio, your government bonds are probably going to do quite well. So if we look at bonds from perspective of it's strictly there to reduce the risk of my stock portfolio, there could be some argument to have more exposure to Canadian safe or government bonds or low risk bonds. I still don't think 50% maybe is still a bit too high, but you have more of an argument, I think, on the bond side if we're talking about some of the safer, more government-focused areas.
Yeah, I completely agree with you there. I mean, when you talk about these times when things turn down, the other big issue in the bond market is liquidity. And so, if you found yourself ventured into the high yield space in Canada, it's hard enough in the easiest of times. It's extremely difficult when things are tighter. And so even in the corporate space, it's similar. Government space though remains generally outside of very extreme events like let's say spring of 2020. These
Yeah.
markets remain quite liquid, and we continue to have a AAA credit rating here in Canada. As much as there is a lot of debt that exists at the government level, when you compare to other developed nations, where on the federal basis we're reasonable. The debt has been kind of just pushed down to the other levels more so. So I think to have a good allocation to Canadian government bonds is not, or an overweight to them. There's good reason to do so.
Yeah. And maybe that's the simplest way to look at this whole home country bias thing is what happens when there's a downturn or significant market shock or recession. What happens in that situation is the Canadian stock market tends to get hurt a little bit more than global stocks, just based on the nature of the concentration and the sector exposures. By the way, global currencies tend to do, especially US dollars, tend to do generally pretty decently under that scenario. So you get a little bit of a boost from that. And also when you have this sort of recessionary or big downturn in the stock market, government of Canada bonds would tend to do pretty well also. So if you're looking at it, and a lot of this trying to avoid home country buys, a lot of it's about risk management. And so if you think of it from that lens, government of Canada bonds tend to do pretty well. Global stocks tend to do better. But certainly, I think we're advocates for diversification right across the board.
Yeah, for sure. But you touched on something there that we hadn't gotten into before, but I think it's another cause of this home bias, and that's currency. And just the view that, and there's this is reasonable to think that if I invest in a country outside of Canada, well, I've not only introduced the idea that I don't know if the stock price is going to go up or down, but I also have to now factor in the currency. How's that going to move as well?
Yeah.
And that's a reasonable, and that's a realistic part of the total return. Now you've added another component, and though really many of these Canadian businesses do business globally and deal in multiple currencies, so those factors are kind of still at play. You just don't see them as much in your face when you're investing in a Canadian stock. So I think that would find its way into creating this home bias, not just in our country, but in others as well, as to say, get to operate in the currency that I transact in. Don't have to worry about it potentially taking a big hit when I sell the investment and the return I thought I made all disappearing. So I bet you that's a part of where home bias comes from too.
Yeah. Yeah. And just to emphasize again, you're probably very right on that, but Canadian investors tend to benefit more often than not, especially on the risk side of things, by having some exposure to foreign currency. So if that is a fear for people, I would probably say just dial down the fear gauge a little bit, because you should look at it as an opportunity, not as much of a risk.
Yeah, and I'd agree with that. And we've seen how our dollar has done over the last while, even just as the case in point. So it's pretty evident that way.
Yeah. I guess the other thing, because as you talk about how our dollar's done recently, the other thing we should probably mention is the leadership for these global markets will tend to last and persist for long periods of time, because it came to mind because you mentioned Canadian dollars haven't done so well recently, but there was a long time there, kind of in the mid 2000s to 2010 or so, when the Canadian dollar was really strong relative to the US dollar. And so this can kind of ebb and flow. It can go for multiple years where Canada is doing quite well, and stocks have done this as well, where the Canadian market has gone for long times and outperformed global markets, outperformed the US market. So that certainly hasn't happened recently, not anywhere close. Actually, it's been probably good 15 years now since that's really been a story, but we can't ignore that possibility either. And I wonder how much of this propensity recently for Canadians to invest more globally is a function of better performance globally.
Yeah, I think I think you're right. We're looking to our neighbors and seeing the returns that they've seen versus what we've seen. But to that point, on the periods when our currency has been strong, I think it's often periods where commodities have also been strong. And so that
Yeah.
component within our markets maybe you get a benefit both ways when you do find yourself in one of those periods. It's been a while since we've been there. We've
Mhm.
been really outside of that for quite some time. But yeah, our dollar has had periods of great strength, but often feels like coincided with periods of commodities being quite strong.
Right. Right. Any final thoughts, Matt?
And final thoughts, I think it just encourage investors view to look at diversification, view it less as risky, view stepping away from home less as risky and more of an effort into expanding your portfolio into industries that don't exist here, into very, very good companies that sit beyond our borders, and that there's rewards not only in terms of expected return, but maybe even a smoother ride getting there as well.
Yeah. Certainly, if you asked us kind of to boil down our investment philosophy to one tenet, as hard as that is, it would probably be diversification is the one thing. And a big part of that is we just don't know what's going to happen in the future. And having some exposure to a bunch of different things that you think can be successful over the long run is going to lead to long run investment success.
Couldn't agree more.
If you're breaking a sweat trying to figure out what your financial advisor is talking about, you're not getting the service you need. You probably hate trying to get an answer from them, but you also think moving your accounts will be a headache, and it might be. But working with don'trocktheboatwealthplanning.com or .ru isn't exactly stress-free, is it?
For more information on the subject of today's podcast or any other financial topic, please visit us online at verecan.com. That's verecan.com. There's plenty of information there, or you can reach out to someone on the team. Thanks for listening.
Please note, the information provided in this podcast is for general information purposes only. It is not intended as financial, investment, legal, tax, accounting, or other professional advice. Our discussions are not a solicitation to buy or sell any securities or to make any specific investments. Any decisions, based on information contained in this podcast, are the sole responsibility of the listener. We strongly advise consulting with a professional financial advisor before making any financial decisions. Listeners should be aware that investing involves risks and that past performance is not indicative of future results. Barenaked Money is produced by Verecan Capital Management, Inc., a licensed portfolio management company in Canada. We operate under the regulatory framework established by the provincial securities commissions in the provinces within which we operate. The views expressed in the podcast are our own and do not necessarily reflect the official policy or position of any regulatory authority. Remember, at Verecan Capital Management, Inc., we focus on aligning our goals with yours, prioritizing integrity and transparency. For more information about us and our services, please visit our website. Thank you for listening, and let's continue to challenge the norms of the financial services industry together.